Alright, so continuation of the trend study. So the market had broken into a downtrend, and we're now in April, early April. So I'm examining the behavior early April here on the chart. A sideways action right there. So March 26th, the average started plunging downward, and then a brief rally on the 31st, and a small 2-day rebound occurred from prior support level on April 4th and 6th. So April 4th and 6th, you had this rally, 2 days, right? Emphasizes the weakness. Note the immediate shrinkage of volume. 2 days, pathetic volume. Emphasizes the weakness. Next, following several days of holding within a narrow range from April 7th to 14th, inclusive as it approaches support, with no evidence of any selling climax nor convincing rally power. So next several days, here, what do you have? Narrow range, no evidence of any selling climax nor rallying power. But as the averages level off, then drift to a dead center, level off and drift to a dead center on the 11th, I think right there. On the 11th, we may reduce our stops on short positions to a point or so, merely to guide against the unexpected change of trend. Stuff like this happens. It's unexpected. This, even Wyckoff realized this. Like, they could have an unexpected change in trend, meaning markets can randomly change from downtrend to uptrend anytime. He realized this. But instead of rallying vigorously away from the dead center after 6 days of holding support, the market tells us there's no buying power by its inability to enlist higher supports or materially expanding volume when it tries to follow up on the advance of the April 13th. On the 15th, a breakdown into new low. All he's saying, he goes up, can't do it, cracked. So how do you know it has no buying power in that little tight range? It can't hold higher support or materially expanding volume when it tries to follow up on the advance on April 13. So April 13 was right here. That's that green bar. Okay. After that green bar, it can't hold higher support when it tries to follow up. What's he saying? They're saying you just can't. There's no follow through. It's green bar, red bar. That's the problem. So that one green bar has no follow through. Damn, it's pretty cold. On the 15th, the breakdown into new low confirms that above indication and affords an opportunity to increase our short line by permitting. So new low, basically he's ready to short. So he takes the short right there. Why? Because of new low. Alright, now you could do this. It's another area where he shorted. So I mean, let's just go quickly over the areas where he shorted that I recall. One was, I think, here. Right? Second was here, halfway back. He doesn't mention the short on here, but I wouldn't be surprised if he would be okay with it, though he's dead. And here again on the new low right there. So increase our short line by pyramiding. With more short sales or some or other stocks which promise to exhibit the great weakness, these sales can be protected by stop order. The persistent increase in volume from April 11 to April 18, accompanied by declining prices, is evidence of what? Liquidation. What's he talking about? He's talking about down, 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 down. Volume up, 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 up. You see? Volume up, 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 up. As the market goes down, 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 down. This is called liquidation. Same concept applied where? Here. Up, volume up, up, price up, 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 volume up, up, up. Bullish, up, 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 up. Bearish, down, 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 down. Move is on increasing volume, gradually increasing volume. What is that? It's liquidation on the downside, and the upside is just called a bullish indication. There are occasional sharp rallies evidently made by short covering, such as on April 13. This kind of buying kept the volume up to around 3 million, but will soon be seen by the performance of May 1st. Such advances are quickly lost because they've covered. Once they're covered, there's no buying power left, and underneath proves to be hollow. So we'll take a look at April 30th and May whatever. That right there is short covering. Why is it short covering? Because typically it has no follow through or very little follow through and immediate reversal. So what you see is market go down, 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 down. It's going to probably hit a support level. When it hits that support level, you get a bar like this, which he's saying is a sharp rally. That sharp rally has very shitty follow through, and that's how you know it's short covering. So this is very important because a lot of times when you're seeing a low being tagged, the market goes up and it makes you think, oh, I'm going to buy low. Let me enter. Don't do it because it's just covering. And it's going to have high volume. It's going to look like volume off the bottom. It's going to look like a sign of strength. It's going to look like all these things, but you need to see the follow through. If follow through sucks, don't do it. It's short covering. Short covering is buying, right? So that buying all of a sudden can lead to an indication of strength. It can lead to what looks like strength, but it's not strength. It's temporary. The volume surge on the 23rd implies a possible selling climax, which suggests that in view of the extent of the decline to date and the fact that the average has now come down to important December support area, we might expect a corrective rally. A normal rally would be about halfway back, which in this case would be up whatever to about 146 because of previous bearish behavior of the averages and the likelihood that we are in a liquidating market. We do not regard this one-day slender evidence nor the possibility of a corrective rebound as threatening to our short positions. However, if we wish, we may reduce the stop losses. When it fails to rally as might be expected, but instead sinks back to almost close at the low point with no shrinkage of volume on the 25th, we recognize that this is vulnerable to fresh selling. So what he's saying here, when you see all this, we think, oh yeah, this is a selling climax, and we might expect a halfway back move, but again, shrinkage volume, and goes right back down. So when it fails to rally, meaning no further upside progress, when it fails to rally as might be expected, but instead sinks back to almost immediately to the close at the low point with no shrinkage in volume. On the 25th, it's a little bit difficult to see here. Again, you're put on guard right here because this came when downward thrust was shortening. Higher volume and less thrust also puts you on hey, watch out type of thing. So slackening of the downward progress on heavy volume also warns us to be on lookout for possible minor turning point. In other words, a belated technical recovery, which may later prove to be the beginning of a more important change depending on how the market behaves during and after the indicated recovery. So he's just trying to tell you what he thinks. Over here, he thinks this is a potential selling climax. It could be, but after that, there's not a lot of juice, and it goes right back down. All right, now, and when it goes down, it increases, and there's a lot of volume, and the thrust from low to low isn't really that much, setting up the technical rally or just the short covering. That short covering is followed by lack of follow-through, which makes you think that, yeah, it is short covering, and to get tested on very little volume, which means it's not going to work. I mean, the long sides are not going to work. Not enough pressure, and not the persistent increase in volume from April 11th to 18th. Okay, I think I did this. Okay, I'm in May. I'll finish that off tomorrow.